Hello, welcome back to the continuing lecture in, investment. Um, so continuing with the discussion of free cash flow model. Um, so we're still talking about free cash flow to the firm, and in this case, important. The crucial thing is that we have to use the we have to use weighted average cost of capital for as the discount rate, because free cash flow to the firm is the fruit of the workings of both debt and equity, right? So it's a combined result, right? So it has to be weighted average. And finally, what you arrive at is the value of the company, right? And since the value of the company is the result of value of equity, common stock, and value of debt, and value of preferred stock, right? We need to isolate the value of the we need to isolate the value of the common stock, right? And isolating the value of the common stock, of course, then is the value of the company minus the value of the debt and the value of the preferred stock. And usually, in a very watered down example, this is, market value of the debt and market value of the preferred stock. The market value being, in these models, they always assume that the market value is equal to the intrinsic value, right? The rational value of the debt or the fair value of the debt, or the fair value of the preferred. Of course, this is under the assumption that the market is in equilibrium, market for debt and market. But in reality, we all know that it's not, most of the times in the short run, it's not at equilibrium. And they are generally given, right? It's to make the example easier for you. And then once you isolate, a value of the common stock, then all you need to do is, because this is an aggregate concept, right? It's all aggregate, right? Value of the company is also aggregate concept. Aggregate. And the value of the so since everything is in aggregate concept, then what you want to know is the individual price of the stock, right? So to find the individual price of the stock, then what do you need to do? You will need to, so I think next slide is about that. Well, it doesn't give you. So finally, then you must divide, right? Value of the stock, right? Finally, you must, because it's an ag value, divide the value of the common stock by number of shares outstanding. It's so hard to. And then you arrive at the per share value of the. So I will use, S0 for per share, right? Stock price per share, right? So this is basically the approach, right? And as I said, as an example, this is a free cash flow to the firm example. Now we will be moving on to a free cash flow to equity holders example. Free cash flow to the equity. We all know free cash flow to the firm is basically, what is this? This is called operating cash flow, right? Operating cash flow, the whole thing, right? EBIT times 1 minus tax rate. So that's only, then tax is already subtracted, right? Right? Because this 1 minus T tax rate will leave only the after-tax, earnings, right? And interest is still included because it's a, potential cash flow to the firm if you're not paying out interest, right? And then, added depreciation, right? Add depreciation. So operating cash flow. And this portion is called investing in operating capital. Okay, that's free cash flow to the firm. Free cash flow to equity holders is obviously from free cash flow to the firm, you subtract interest payment because, to the equity holders, then the firm will have to first pay interest, right? And then whatever is left will go to the equity holders, right? And then why 1 minus tau C? Tau C is, corporate tax rate, because there is a this is something discussed already in Finance 230, corporate finance. It's the tax shelter, or tax break from, as much as the tax you're saving on interest payment. In other words, interest is tax deductible. I mean, what that means is actually, when businesses pay out interest, it will reduce the tax by as much as the interest, right? Let's use this, because think about it. EBIT is operating income, and also earnings, another name, operating income, right? And then from there, from operating income, you must pay interest taxes. Interest payment. And after paying interest payment is called what? Of course, it should be called EBT, right? Earnings before taxes, right? Interest is gone, I is gone, right? Another name for this, taxable income. Taxable income. And then you subtract taxes, but think about it. There you go, and then you finally arrive at EAT, earnings after taxes, or net profit, or net income. Net income or net profit. It's not divided by, it's simply slash. Net profit, okay? Now then, if there was no interest, then your EBT will be exactly EBIT, right? If this is 0, then these two will be the same thing, right? But because interest is positive, positive number, right? Right. I mean, if that is positive number, the EBT will go down by as much as interest. Right? It will go down. It will go down by as much as interest, right? So, interest is tax deductible means, interest is already, it happens before taxes. And, the entire interest payment is already deducted before paying taxes, so it reduces, EBT, and then the taxes would go down, right? Because the smaller the EBT, because taxes simply the tax rate. Tax is simply, EBT times the tax rate. So if so, it's obvious, right? This is what they mean by tax deductible. Interest is tax deductible. Interest doesn't pay taxes, and because of this, interest interest payment has effect of tax break by as much as the tax rate. So from the equity holders' perspective, interest is, because equity holders are owners, right? Interest payment is an expense to them. and then actually by as much as the tax rate, uh, you are, benefiting from the fact that the company is paying taxes, right? And then the change in net debt. So change in net debt is coming from what is the source of change in net debt? So suppose you are making principal repayment, right? If you're making principal repayment, right? It's gonna lower the free cash flow. But again, if there is if you're selling new bonds, right? If you're selling new bonds, then there is proceeds. In other words, there's cash flow from sale of new bonds. That's new debt. So, so if you the balance between principal repayment and the cash flow from the sale of new debt, that is the change in net debt. Okay, and then actually the sign of this, I think it looks like if principal repayment is greater than the cash flow from new bonds, then it will be negative. It will have to be negative. So that doesn't. That looks a little weird, but let me Let me just let me make sure. Let me check. So increasing the net debt should be if you in the from cash flow perspective. Actually, it should be switched, right? I mean, if this number. So what I tried to, what I should have done is, how did I switch this? Yeah, so I have to do it this way. I think I just, wrote this principal repayment first and then subtracted. So it is, minus principal repay. Right. So think about it. If you have, when the bonds mature, you have to retire the bonds, so you pay off. That will reduce the cash flow. And if you sold, new bonds, then that is the positive, this cash inflow, and this number will be positive. It will increase the free cash flow, right? It will increase the free cash flow to the firm. But if If you have no proceeds from sale of new bonds, in other words, if there's no sale of new bonds, then this will be negative and reduce the free cash flow to the equity holders, right? And then this has an advantage. Free cash flow to equity holders has an advantage. Advantage over what? Advantage over free cash flow to the firm. Why? Because to use free cash flow to the firm, you have to know value of debt and value of preferred stocks, right? And of course, number of shares should be known to eventually get to. So this thing is number of shares should be known. I mean, you can get to a value of equity. You can still get to value of equity as an aggregate value, but to get to per share, you should also know number of shares outstanding. Yeah, but anyway, alternate methods when alternate methods when number of value of debt and value of preferred stock are unknown. Now, of course, I've been telling you over and over repeatedly that market value is not intrinsic value in the short run, right? But at equilibrium, which means long run, right? In the long run, or at equilibrium, right? We are assuming that intrinsic value is a market is correctly pricing in the intrinsic value of the asset. So it's based on that assumption. So then another benefit is, look, what do you see here? You don't have to use weighted average cost of capital, right? I wouldn't cross it out, not necessary. Not needed, right? Weighted average cost of capital needed. So two advantages actually, right? You don't have to know market value of debt, market value of preferred stock, and you can use simply cost of equity because you are valuing directly equity, right? It's the value of equity, right? So, and it's still the same golden growth. For the first few years, we are making a forecast of free cash flow, and you discount it all the way to the present. And finally, when the cash flow growth goes into a steady state, then you use golden growth model. So basically, this thing is wrong. It's like I don't know why. I just copied this symbol and I copied this equation here and simply switched around. So that tagged along. This is actually value of the terminal value. This terminal value of free cash flow will have to be following golden growth model. Okay, so This example actually, we already know free cash flow model is very useful when we're valuing companies that don't pay out any dividends. And then, as an example of this problem, right? Free cash valuation, and this example, there is an Excel file in the in our topics folder, right? Course materials folder, and this is for both. This is quite an extensive model. Free cash flow. It's so hard. Free cash flow to the firm and free cash flow to equity holders. Free cash flow to equity. Okay. And then we're going to actually use, let me show you. So I will have to go back to stop sharing and then entire screen. Okay, you will be seeing the entire screen. Now, about now, okay. Now let me go back to CPU or RAM is lacking. RAM capacity is, but in this, this is our folder, right? Topics folder, and if you scroll down, there are two. There was, we did this exercise, right? We did this one, and this is the one. This is the spreadsheet 13-2. This is the exercise that we are going to do. And you will find, it's not exactly like what's on the exactly like what's on here, because the input data has been updated. Input data has been updated, right? Okay, so I'm gonna have to but we don't have time for this exercise on this video, so we'll do this exercise in the next video. Okay, all righty. So I'll stop recording and see you in the next class or next video. Okay.